Hello, welcome to our first Intrablocks Blockchain Bistro. I'm Walid Alsaka, founder of Intrablocks, and we're very big welcome to all of you here. So, joining me for this first show, I've got Rory Onsworth, partner at Intrablocks. Say hi, Rory. Excellent. And I got Mark Simpson, partner at Intrablocks. Say hi, Mark.
Hey, Walid. Hi, everybody.
Hi. So, to kick things right off, Rory, could you please give us an introduction as to why we've called this show the Intrablocks Blockchain Bistro? And what is a bistro?
Very pleased to do so. So people tend to like bistros. I think that's where we start. So they're typically Parisian establishments with a very special flavor. So they start off with landlords owning those big Haussmannian buildings in central Paris that you can see there, and renting out the flats. And their tenants want convenience, so they've got busy working people. So the landlords open their basements as restaurants. So convenience is really the heart of this bistro concept. And even the name bistro is thought to come from the Russian word for quick, which is what the Russian troops would shout at the waiters when they were hungry, and which is also what you can do at us if we're taking too long or if the subject doesn't interest you. So it's not the most refined dining environment, but it rapidly became a genre of establishment which really belongs in that space. The food was mass market and culturally non-specific, whatever the patron said they wanted, with the cooks who were recruited basically because they could cook that kind of food. And that's why Intrablocks wants to open its basement to you. We've been asked to. And we don't have a lofty ambition. We just want to serve you up some quick convenience food for your brain, and off we go. And like the Russian troops, it's pretty informal. You can consume as quickly as you like, and you can shout if it's not working for you. And if you don't shout today, what we'll have the pleasure of serving you is a starter, which is a sort of high-level summary of the issue, followed by the main course, which is the deep dive. And by deep dive, we don't mean super deep. We mean 10, 15 minutes. But the dessert is a Q&A and a general discussion around the call to action. So on with the content, Walid.
Excellent, thank you. And for those of you who like to have your dessert at the same time as the main dish, please don't hesitate to put your questions in the comment section so that we can answer them as we go along. But without further ado, for this week's Bistro, we're going to discuss COVID-19 and the economic downturn's effect on P&C insurance and whether or not it represents an opportunity for technology. And I'm very pleased to have returning to Intrablocks, Patrick Schmid, Vice President at RiskStream Collaborative. Patrick, thank you for coming back to us. Could you please give us a quick introduction on yourself?
Sure. Hey, thanks for having me. Happy to be here. Hi, everyone. I'm Patrick Schmid. I'm Vice President of the Institute's RiskStream Collaborative. RiskStream is a not-for-profit blockchain consortium operating in the risk management and insurance space. We have a large amount of members, carriers, brokers, reinsurance firms, and we created a DLT architecture for DLT applications to be built upon with the goal of streamlining the flow, the verification of data for the insurance industry. We were founded by the Institutes, which is a 501c3 not-for-profit serving the risk management insurance industry. It was founded 100 years ago out of the Wharton School. The Institutes is unique in the sense that it has a network already. It educates over 100,000 students annually and has a board representing generally CEOs that represent about 50 to 60% of domestic insurance premium volume and a sizable international presence as well. My background, I started at the Institutes in research. I worked as a director of research for the Insurance Research Council, and I led the enterprise research department before kind of bringing our blockchain initiative to life. Prior to that, I entered into the insurance industry about a decade ago. Prior to that, I obtained my doctorate in economics. We'll talk a little bit about economics today. And I was an economist for Moody's Analytics during the financial crisis. And I've taught economics and finance at a variety of universities in the Philadelphia area. I'm pleased to be a part of the first blockchain bistro and to talk to you about all of the above, blockchain, insurance, and economics. So I think we have quite a menu here.
Excellent. Excellent. I brought a little espresso to go with the bistro, so I hope you all have your drinks along. Now, Patrick, you originally wrote a Medium article on the impact of COVID-19, which was one of the reasons we had you back on the podcast show, episode 111, this week. So rather than repeat the whole podcast, we'd like to build on that and think about how we can apply this information and what actions we might take, as an industry. But just before we do that, could you perhaps give us like a 2-minute synopsis of your podcast with us?
Sure. So obviously, the coronavirus and the shelter-in-place response has wounded. Our article really zoomed in on the U.S. economy. Business and consumer-oriented economic indicators continue to show the extent of the damage, and the economic data that's been released so far in the spring and what we expect in the summer are expected to demonstrate further deterioration. The P&C insurance industry is really not immune to this. The downturn is likely to strain some profitability, the underwriting profits, and the decline in interest rates, which the Federal Reserve enacted to try to spur the economy, is going to impact net investment yields for the industry, which is likely to exacerbate profitability efforts or the challenges with profitability efforts. So the P&C insurance industry should expect that there's going to be differences depending on line in terms of the impact. And what we talked a little bit about in our discussion was the line by line policy and loss impacts. But in addition to that, we also asked the question, does this pandemic and the response, the economic downturn, does it expedite technological change? Does it change the cost-benefit decision-making process for insurers that have been kind of put to the point where they've gotten pretty close to the finish line in adopting technology, but haven't quite pulled that trigger yet? So that's really what we talked about in the podcast, and I'm happy to be back on the show to talk a little bit more about that.
Great. Well, it's great to have you back with us, Patrick. So at a time when it can be easy for leaders to entrench themselves and to resort to simple cost cutting, and we've heard so many announcements of layoffs, of people having to take 20 to 30% pay cuts, on what they may view as a discretionary kind of innovation spend. How do we make a compelling case for them to look at innovation instead of just cutting all across everywhere? What are your views, gentlemen?
I think, that's really the key question. How do we look long-term into the future and ensure folks that now is the time to invest in that future? It's a really scary time, from an economic standpoint. Data released in May, which we didn't really talk about, continues to show that manufacturing activity, residential housing, trade, business formations, retail and food sales, all are showing kind of negative signs. Residential construction was down 30%, retail and food down 16%, all numbers coming in this month. And this is bound to scare a lot of people. Nonetheless, we have to remember, while there are undoubtedly some problems with the economy, this downturn wasn't necessarily foundational. It's confidence driven. And the turnaround is very dependent on consumer confidence. So back to your question on innovation spend, I'm not sure of the exact best answer there for businesses in general, but it's likely the economist in me that thinks about things on the margin, cost benefit. And for 1 unit of spend in project A, what do I get 1 year, 3 years down the line for that versus a 1 unit spend in project B? What do I get 1 year, 3 years down the line for that? And I think it's important to understand the time value of money here. So one of the things we discussed on the podcast is the challenging environment for insurers, the fact that policy reductions and loss spikes are possible, and on average, combined ratios may increase, indicating that the industry is paying out more money in claims than it's making from policies. And adding to the stress is the fact that the interest rate environment is so low, so they can't reap those rewards from investments. So one thought is, if you can't obtain that external rate of return, perhaps use some of that capital internally to help with short-term, medium-term, and long-term operational efficiency. So rather than looking toward external investments that are yielding extremely low interest rates, it's potentially possible you look intern. I know that may be debatable depending on what you're looking at, but investment now may lead to a competitive advantage in a few months down the road. And I mean, one thing 2020, I think, has shown us all is that the world is extremely unpredictable, and therefore having that competitive advantage in the future might be worthwhile.
Patrick, maybe a question for me now. What do you think about this notion of FOMO, or fear of missing out? Do you think that could have an impact as people become more aware of the opportunities that they have, and as the benchmark is sort of established and then goes up? I mean, I think in the podcast you mentioned something around Standard & Poor's beginning to comment on that type of topic. Is there something happening there?
Yeah, I think that, in particular, AM Best and States, its credit rating agency, that has really been looking at the insurance industry, and, they've created an innovation index. And I think it's kind of, the insurance industry in general has gotten to a point where they clearly made investments, but there's a lot of legacy systems within the industry that haven't been updated. And it's not just the legacy systems, it's new technologies like blockchain, like AI, different types of technologies, different types of innovation. And I think what the credit rating agencies are basically saying is, if you don't start to innovate now, you're going to be in a position down the road where you're going to be left behind. And therefore, it's kind of creating this dynamic within the industry where I think the insurers have to make a choice. We've gotten to the point where we've made some investments. There's innovation departments scattered throughout the folks that we're dealing with the RiskStream consortium. Generally, we start with the innovation departments. So it's clear that the industry at large has invested in innovation, but have they pulled the trigger on these new technologies? And I think what we were trying to say in the podcast was, that cost benefit for pulling the trigger is different now than it was in the past. You really, in order to be competitive in the future, you really need to start to make these decisions now and invest now. That's my take on it. What do you think?
Well, to add to it, Patrick, and what I would say as well is our experiences this side of the pond are very similar to yours. I mean, the UK's had the longest sustained low interest rates since the banking system began here in the 1700s. So lots of things, and arguably the current situation, as many before has done, is just exposed the fragility of some of the models. And I'm with you on this. You can use an internal investment rather than an external, and I would also say you cannot afford to not be digital at the moment. So what we're seeing at this state, where people are just about surviving and limping, the ones that are really struggling are the ones that are nowhere near digital. The ones that are kind of getting by pretty well and enhancing are already on digital. And the reality of that is more that the rest of the world is already going digital. I mean, every week, every day, we see new initiatives around our customers, i.e. customers in the insurance industry, doing stuff with technology. And quite frankly, if you're an underwriter at the moment and you're writing pretty much any class, then digital is affecting you. So you're doing one of two things. You're either underwriting blind because you've got a pocket of ignorance, or you're putting a risk premium on that, which, when we're seeing downward pressure on rates and we're seeing downward investment, means that you're going to be uncompetitive. And so I would say you've got to do that. If you're a CEO, you can almost argue it's a bad news story at the moment. So let's kind of swallow that, but let's invest in the medium and long term. And then we got three levers, quite frankly. Insurance is fairly simple. What am I going to do to reduce my admin costs? That's controllable to me. So any sort of innovation, digitization around that's going to help. I can think about my claims indemnity cost reduction, and that's beyond just fraud, but how can I stop things escalate? As an industry, can we move beyond remediation, and in fact, beyond detect and mitigate into actually enhance, detect, protect, and remediate? And then finally, where's the growth opportunity? And again, there's a huge amount of growth that will come out of digital, but when we're more competitive, we can grow into other markets. So for me, I don't see any other option.
That makes sense.
Yeah. At the same time, as you can see on the screen, we had just received a question from Tony Buckle asking, how do you see insurance brokers and blockchain working together? Do you believe, from a RiskStream collaborative, Patrick, that this pandemic is actually giving brokers also this opportunity to consider technologies such as blockchain and that they should engage with it?
Yeah, I think it depends on the specific use case, but yeah, I mean, we're working with brokers on a couple fronts. One of the areas that we're working with brokers on is reinsurance placement. We have a solution that we're working with the working group, organizations like Aon and Marsh on that topic. But in addition to that, we also have a working group for certificates of insurance. And in the commercial lines space, we think that there's a lot of potential in commercial lines, outside of certificates of insurance. So I think that there's certainly appetite for broker involvement within a variety of different use cases for blockchain. I think that personally, our take on it from a RiskStream standpoint is we don't see, even with the pandemic and et cetera, any real change to the structure of the industry. We don't really see brokers going anywhere. We see carriers, reinsurers, brokers as members of the RiskStream collaborative. And we think that there's use cases to streamline the flow and verification and ease of sharing information between these different parties. There's a ton of issues within the risk management insurance industry, just from reconciliation alone. So data sharing is probably one use case between these different parties that I think most parties can agree could cause all sorts of efficiencies within the industry. So that's really the areas that we tend to zone in on within RiskStream. What do you guys think?
I think you're absolutely right, Patrick. I think it's about task, isn't it? It's not about sort of role. It's really about what tasks are people doing now. Everyone has one or two tasks they're doing. I'm a lawyer. Of course, AI and so forth is going to tremendously change what we do. Does this mean that lawyers won't exist in the future? No. And by the time a broker gets the blockchain, the amount of value-adding thinking that they've done around how to effect the placement, how to structure it, and so forth is huge. So I think it's tasks. Some will go quicker, some will no longer exist. They'll be done by the machine, but I like you see the broker role as being continuing to be important, just changing a little bit in types of tasks that they do.
I think as well, if we go back to the fundamentals where brokers started and where they are, they're experts at understanding risk. Yeah, they're fantastic at making markets and bringing parties together. And then what tended to evolve is they got dragged into some admin doing some lower value tasks that they didn't particularly value. Their customers ultimately didn't particularly value. And it just puts a whole burden on them. And in the UK, we've got, CAS 5, client monies returns. The best that happens for a broker is you expend effort and you comply, because otherwise you can be fined. And I see Paul Moiston's on here. We were at SCOR's Investor Day in a room with SCOR clients, insurers, brokers, reinsurers, and capital. And the only two people in the room that didn't think they were going to be disintermediated were the ultimate customer and the capital, and everybody else felt it's going to go. And it isn't. There's an opportunity to disintermediate ineffective practices, but we still need these. And brokers, as a specific, have shown themselves to be hugely adaptable over the years, and I'm pretty confident they'll continue to do that anyway.
And talking about Paul Mewson, ex-CEO of B3I, so his point is closing the protection gap is a noble goal of many insurers. As we digitize people and asset data, do you believe that insurers will now be able to access new risks, pools, or lines? And I think that's quite an interesting point, because this pandemic has really opened up the opportunity to really look at those who are not insured, who are completely have missed this opportunity, and is the opportunity to use these new technologies to enable us to be able to reach out to them in a profitable manner. What are your views?
I mean, I would say in short, absolutely yes. I mean, one of my clients from wealth management has a great term. I mean, everybody talks about data being the new oil, and they say, no, data's the new soil. Because, insurance isn't so happy with fossil fuels and it's trying to do its bit to reduce it. But actually, it's something that you can grow things out of. If you take care of it, you tender it, you nurture it and grow it, it's there. And we also know from people like, the Geneva Association that do a tremendous amount of great research, so many people on the planet are underinsured. And that's not just in what we call developing nations. In the United States, in the UK, there's this combination of being overprotected in some areas, underprotected in others. There's a huge amount of growth. Why can't we access it? Ken Mark usually describes it as 3 levers. Insurance isn't relevant, accessible, or affordable. So can technology help us to tackle those 3 things? Absolutely.
I would add to that the insurance industry has so many areas in which they can cut costs. And if you can cut costs through reconciliation, through administrative burden, through fraud, even through maybe regulatory environments, it's potentially possible to serve additional areas. I think the emerging markets, for example, have been challenging for the insurance industry to enter into because of the costs of doing such. But, if you can figure out ways to cut the costs, and technology can help here, I think that has, huge potential for us to start looking into, cutting the costs associated with the administrative burden, the reconciliation issues between different parties, that type of thing. That allows the insurance industry to start considering some new avenues that maybe it wouldn't have been able to consider in the past. So I do think a lot of this has to do with technology myself in terms of how we can get there.
Yeah. I mean, I agree. I mean, again, and I know this isn't just about microinsurance, but, I know from speaking to the guys at Blockshaw, they did some stuff on microinsurance where they brought the unit cost down to less than 0.5 of a cent on it because it was fully automated. And that's a massive difference in terms of being able to hit an accessible market. And again, we know that the guys at Aon have been doing stuff with Oxfam on farmers. So there's many stories of this. And it's not just, as I said, at the micro level. We've seen massive savings at the other end of the market. So I think it's bound to open up new pools.
And I think we shouldn't be necessarily put off by some of the failures. There'll be failures along the way too, right? There'll be things we try. I think the big one at the beginning was this flight delay insurance,
Yeah.
And in the end, consumers didn't really want it. But that doesn't mean that itself, the findings from that can't feed into other successful efforts. And so it's all moving.
I agree. I think many of us will stand on the shoulders of the likes of Fizzy that really, proved the real potential of what's there. I think and for me, that wasn't a failure. Okay. Economically, was it considered, something that they could take into a longer term viability? Not at this point, but maybe there were just better options. We don't know the full story, but I still think it was a great piece of work.
Yeah.
Agreed. So, I mean, we've got a number of insurers from who are listening at this point of time to this LinkedIn Live. What do you recommend they should focus on at this time in terms of innovation, in terms of DLT? Should they be looking at moving to digital? Is it they should be focusing on collaborating with others, standardization of data? They all realize there's pain. They all realize they have some big costs. They all fundamentally know there's a way of doing things better. What would you say if they're all sitting around at a table at one of your working groups, at RiskStream Collaborative, to get them to focus on? What would be your top tips?
Well, it's a great question. In terms of focus, I think, there's certain elements that are short term, through the new environment. Of course, the moving to the work from home type situation was something that a lot of insurers had to do recently. Just trying to streamline the volatility in your business operations is another thing that I think is obviously a must. But then when you start thinking about DLT type solutions, trying to find ones that really could help with this new environment. I'll give you an example. With one of our use cases, we really look at first notice of loss data sharing. There's literally, I think, 0% chance that sharing first notice of loss information between carriers in real time within an insurer network wouldn't save those carriers money. It would improve operational efficiency. I think it's painting the picture and trying to start to estimate the savings. That's tricky. But the next step is documenting what those savings actually are. And we're excited about this step because while we feel it's exciting that we have on our consortium proof of insurance and first notice of loss, personal lines auto applications that could offer our members significant savings, we know that they're estimates. And even if they're incredibly precise, they're still estimates. We've started talking to our members about shadow production this year and starting to document legitimate cost savings from our app versus what's traditionally done. So on the one hand, you're doing the traditional F&OL data sharing versus this new opportunity. So is it really the case that for each F&OL, there's really 5 exchanges back and forth between carriers? Is it really true that it's 15 minutes in length each time? And then starting to actually really look into what the potential cost savings seems to be a net win-win. But on top of that, that's just the things that we can measure. When we start thinking about the new world, I mean, secure information sharing, DLT provides this. With more people working from home due to COVID-19, there could be increased security risks, right? I mean, in some cases, if you're doing phone calls from person to person related to an F&OL, it's possible that the employees are expensing these calls back to their company. And you know, if there was a DLT solution, you're saving money there. And on top of that, you have things like the customer experience, potential improvements there from using a proof of insurance application where you don't have to touch someone else's card or touch, you know, there's a touchless experience there. Or with first notice of loss, there's potential for a proactive approach to contacting your policyholder before they call in an incident. And then finally, like we mentioned before, the credit rating agencies are already on top of this, saying that you need to start looking into some of these innovative new approaches to these types of problems. So I think, you know, that's one example that we're focusing on over at RiskStream, is looking at the first notice of loss data sharing. And I think there's a lot of potential there for, you know, increased focus on how this could benefit in kind of the new world. But what do you guys think?
First, I share your experience, Patrick, of one of the big challenges for me is often, and we've worked on a number of models to help articulate the potential for saving. And typically it ranges from, some insurers have got a real good handle on their cost at a high level, but less so at a kind of a task level. So when you start diving into that, it's kind of difficult for them to articulate what that is. And when you're comparing them, here's our cost and here's what we'll deliver, it almost becomes a gut instinct of, is that right or wrong? What I would say is this has become a bit of a catalyst. Technology is a catalyst for understanding and starting to measure it. And, you know, we share a similar thing. You know, the UK auto industry hasn't made a cumulative profit in 9 years. And that's a conservative estimate. One of my friends, a COO from motor business, says it's actually 30 years. So I think we can say directionally, we know there's a great opportunity to make some savings. And I would agree with you at the moment that pulling a couple of those first levers on admin and even a smooth ethanol process can help the claim not escalate, you know, at a site. The fact that you can intervene and make contact quickly and actually step in and to start to remediate quickly can directly help. It also takes care of customers. You know, we're aligned in wanting to take care of them. They can have a better experience. That can definitely work. But I also get the need to be quite precise and tangible. So, for example, if we can reduce the reconciliation time on exchanging information between parties, you know, the good old bordereau. I mean, blockchain should obfuscate the need for the bordereau. But that's a great example, and we've spoken to organisations that say, look, we're pretty confident that if we put DLT in, we can see a 30% plus saving on our admin processing time, and that's, you know, that's through some pretty precise measurements. So, you know, I would say I'm focusing on those first 2 levers first, the admin cost reduction and the claim costs, because they're easier to comprehend and sell and understand and kind of move on. And the premium growth is a bigger prize for me, but I think we've got to kind of earn our seat at the table first is where I kind of sit on it.
Makes sense to me.
So I just want to interject for a second there, because we touch upon the issue about security whilst doing our day-to-day job whilst working from home, and that brings us to the point in a way that Paul Musin pointed out, that if data is the new soil and insurers want our data, how do we address people's cyber and privacy risk concerns? And again, taking into the context that we're working from home at the moment. How are you looking at that from that perspective?
Well, Paul is looking at himself, isn't he?
Yeah. Well, I mean, I would say again, I mean, a couple of things, and it isn't just one technology on its own, but I still see blockchain as a piece of plumbing. I'm really confident that in a few years' time, in the same way that we no longer talk about SQL Server or other variants in terms of underpinning what we do. I mean, you look at most of the websites out there, what's powering them behind them is some form of relational database. We used to get really excited about that. I remember working on some of the first commercial World Wide Web installations in the mid-90s. I think blockchain will go the same way, but in answer to the cyber and the privacy risks, I think it will enable more about self-sovereignty over data. So, in the simple example, I normally give over all my information to my insurer. When I stop becoming a customer, it's still there. And then I've got to repeat the process of handing this data to the next insurer, the ability to turn that on and off. And if we take that, for example, in a commercial property type example, the risk manager will prepare with the broker a risk submission pack. The broker will typically then ask some questions, go back to the client, the risk manager, and then they'll augment it and add their own data. They don't tell the client about that, and it moves on. Then they pass it to a series of insurers who repeat the process. And by the time we got to the end of the chain with some retrocessionaire, the data looks really different in loads of areas. When the reality is, if that was a distributed and shared source, that the ultimate client or parties that were responsible for creating that could turn on and off, then we can all trust that. I'm really happy to share information if I've got control over how it's used and when it's used. So for me, I think it's a key part of us having greater confidence, greater freedom, and actually starting to think about, and I was speaking to Andy Martin at IBM about this earlier in the week, about what do we do from getting people to think about it from a token economy, and what do we need? And I was talking at it from a beliefs and behavior point of view. And fundamentally, this is a trust exercise.
And I would add that people also need to take it more seriously for themselves. So, the systems need to be put in place so that they can do so. But, how many times do people just click the accept all cookies button because it's offered without thinking about, what that means? And so I think it should be kind of a bit of both, shouldn't it? The systems should be there, but the people should really do select the options they want.
I think you touched on an interesting point, Mark, which is around self-sovereign identity. Because self-sovereign identity is not just down to the individual, it's also down to the piece of data. That piece of data is self-sovereign. It has a capacity to interact with other pieces of data and make its own decisions. And that opens up the whole idea of new marketplaces, of sharing of information. But I think coming back to your point, Rory, there is also, I would argue, an element of user experience, in some ways. How do you make those kinds of interfaces easy for people to comprehend and to modify in a manner that serves their purpose? And that's something which very few internet companies, even less, I would say, DLT companies are looking at. But it's something that is crucial for us, for this kind of technology to go mainstream.
Yeah, I'd agree with that too. And I'd just add to this that, when you start thinking about it in a particular area, like auto, for example, there's a lot of potential there for a lot of challenges that we face today. When you're pulled over in your automobile today, you're going to take out your insurance card. The police officer who pulls you over has to come up and approach the vehicle, which is a security risk. I mean, we're seeing a lot of that today. What if there's potential for that police officer to understand your insurance information without exiting the vehicle? The insurance world today is challenging with that because, you know, the liability follows the person, and then you have the insurance following the car as well. So there's kind of a complex nature there. You can't really just read the plates behind the automobile. But in the future, it might be possible with self-sovereign ID for that driver's information to be shared with the vehicle, which could be shared with another automobile. And therefore, there would be no security risk. There's a lot of potential with these types of things. And we're thinking about that with proof of insurance. But we've been talking to other consortia, too, about some of the work related to the UBI, usage-based insurance, which is pretty important in today's day and age. And I really think, you know, one of the things we talked about in the podcast is that type of situation, the cost benefit with what's going on today, might start changing people's habits in terms of what they're willing to provide from a data standpoint. And I think that, you know, it's likely what's going to happen is that the insurance industry will move in a very, very deliberate approach on that question related to security, really focusing in on where there's known security. But as that advances and data security improves and blockchain is leveraged for that, I think that there's real potential here for some really neat use cases. I mean, one example would be if you're in an automobile, you're leveraging usage-based insurance. The automobile basically knows who you are. You're involved in an accident. That first notice of loss could be immediately shared from the vehicle to your insurer in the future using IoT. Another example would be in, you know, flood, where you have an IoT type sensor that enacts an FNOL directly from, you know, sensing something. The challenge today with a lot of these things, I think, is the sensors aren't necessarily 100% secure, and there's potential for spoofing and issues with the sensors. But I think in the future, if we could get more reliable, secure data and share that in an effective way, there's all sorts of potential for where the insurance world could go.
And just want to come back to regarding this point of, you know, the first notification of loss regarding to the subrogation policies. Now, we've got this comment here from Christian Felderer, which says, you know, how would you achieve a radical change on product design? So for this particular product, is it such a radical change? And do you think that DLT is an obstacle? Because surely I would say DLT is an opportunity to actually upgrade these products, or is it about reinventing them? How would you see it?
For us, it's not about changing it at all. In fact, we had a do no harm type approach. So imagine you have your claim system today as it stands, and let's just say company A versus company B. These two parties are in an accident, two policyholders call in, and then the claim systems, they have to exchange that information related to the claim. We don't do any harm. They still call in exactly the way they do today. The DLT shares that information with one another's claim system, so that from a you know, company A standpoint, nothing's different. The information is being put into the claim system through the DLT. So there's really no change. And we did that on purpose because our members directly asked us, we don't want a harmed approach here. We want the ability to field those calls like we have in the past for right now. And we want the information to be shared directly into our claims administration database. And that's exactly what we've done with the first notice of loss application.
I mean,
but quickly, just feeding on that. Sorry, so just very rapidly. So, you know, Daniel Redding, you know, put this point that saying, well, you know, the last 5 years, insurance products haven't changed the actual, you know, the policy itself. Can DLT replace that policy and exclusions? I mean, surely this is an opportunity. And then, you know, I would love, you know, Rory to, you know, to feed in on that, you know, in terms of maybe rewriting those actual policies so that they make more sense and that it can be executed within a smart contract kind of situation.
Yeah, I mean, like Patrick, I wouldn't necessarily try and change it, but what I would do is I would use other technologies to tokenize it or to interpret the words and to feed them into the DLT in a meta format, right? So you know, we're stuck with the indemnity principle. It's one of the most complicating factors of an insurance policy, but it's also what makes it work, right? So we can't replace that. But I would say that you could take two routes. You could try to standardize, and in the simplest areas you may be able to. So it may be that an initiative like B3I's CAT product, that they can actually move towards a standardized view of what a cat product is. But I would say that if you use the whole tech stack and use some AI, some semantic intelligence, all this kind of thing, you can start to cluster the individual clauses into buckets of meaning. And then those buckets of meaning can be triaged into two camps, either capable of smart contracting or not, capable of being automated or not. But much of it can be, not all of it, but much of it can be. And so I would say you need those. DLT needs to work with all the other things that are available, not just as a standalone. Mark refers to it as plumbing, and I think that's the right way to look at it.
But just one thing I would slightly disagree on, and maybe to answer Daniel's question about replacing the policy of exclusions, I don't think anything is necessarily binary. So I'm always looking for ands, not ors. So Patrick, I think you had a great example. And if we go back to the auto example, and again, where it's kind of contingent on the insurance on the individual and the vehicle, with other forms of technology and with the plumbing of DLT, I can envisage a scenario where a driver gets into a car, puts his hands on the steering wheel, and one of the conditions of the vehicle starting is a valid policy that either the vehicle covers any driver or the driver is covered to do that. Yep. So in many other lines, it's kind of a subject to clause. So what insurance starts to do is it starts to become a mechanism that enables and facilitates a better system approach. And then knowing that the vehicle starts, or if, and I know people who are listening now will say, yeah, but you can always game the system and do that. Yes, but let's not be binary about it. But also, we've seen when an officer wants to stop a vehicle, maybe the reason for stopping it now is no longer the inquiry of, do you have valid insurance? It can be for another reason. If they're stopping you for that, it's conditional that the car's on the road, or it can beacon to say, I'm not there. So rather than thinking about DLT replacing, I'm saying it's a piece of plumbing that can enhance the way that we try and protect people. And insurance, for me, shouldn't be about a product orientation. I'd rather see insurance as service-led, product-backed, and it's currently product-led with some service occasionally. So that's the opportunity for me.
That's a great point, and I agree with everything you said there. And I would just add to that the importance of that in the States. 13% of drivers in the States, according to the Insurance Research Council, are uninsured.
Yeah.
Even if you could get a moderate decline,
1%, yeah,
that's a huge market right there. Just 3%, and that's some of the leading members in the RiskStream consortium at 3% market share. That's a huge amount, and it would lead to cost savings for insurers. It's beneficial to the insurance company, to policymakers who are creating all sorts of state-run, individualized state-run databases to verify insurance coverage. Blockchain has huge potential from a distributed standpoint, particularly in the States, to get around some of these issues and stop the concept of doing a statewide database here, a random sample there, web services down here. You have one way of sharing that information. The compliance issues for some of these leading property casualty insurance firms with just complying with those state-run databases is extremely expensive to them. They have whole departments devoted to that. So I completely agree. I think this is a rational way in the future to start handling some of these kind of public policy problems like uninsured motorists.
Yeah, so, and it is. I hear some of the states are way higher than 13% as well. I mean, some of them are big numbers.
Yes, it depends on the state. I think Mississippi, if I recall correctly, was one of the ones that was very, very high.
Yeah.
So I want to bring up another aspect of this conversation, which is around the regulators, which Tony Buckle asked a good question, which is, are you hearing from regulators that they're going to enable blockchain? What is their level of interest with regarding to blockchain? Are they resisting to it? Are they embracing it? And here I want to make the clear distinction between enterprise blockchains and crypto, because these are very two different subjects, and the regulators have very two different views. We had Peter Zelgavis, who heads the digital unit for innovation and blockchain at the European Commission on our show not too long ago. And he was talking about how they're looking at having a regulatory sandbox across the EU to look at blockchain and to facilitate it across the European Union. Is there such kind of approaches by the US regulators?
Yeah, the NAIC is looking into blockchain quite a bit, the National Association of Insurance Commissioners. We've talked to state government and the NAIC about what we're doing. Basically what we're trying to do is just make sure they're aware of, this first notice of loss application, for example. Make sure they understand what we're trying to do. The fact that we're not using, to your point, not using cryptocurrency. This has nothing to do with Bitcoin or anything like that. It's just a means of sharing information. And quite frankly, it might be a more secure way. Today, people leverage a phone call to call carrier A to call carrier B, or in some cases use email to exchange information between these two parties, which gets me back to work from home and security risks associated with that. So I think that the NAIC is generally aware. They're supportive of learning more. And quite frankly, it might be really beneficial technology to them in the future. It's not necessarily a zero-sum game here. It's potentially beneficial to both the consumer, the insurance company, and the regulator to start learning more about the technology, because it's potentially possible to create a regulator node within kind of a network system where they get certain information that they're looking for in a more efficient manner. And it's efficient for the insurance companies too to provide that certain information to those regulators, rather than having huge compliance departments doing that on a case-by-case basis. That's our take on the states. But what are you guys hearing elsewhere?
Well, first of all, Patrick, I completely agree with you. I mean, I think the opportunity for DLT to enable what I call pull regulation, because at the moment, as a carrier, you're a broker, anybody else, you're going through these episodes of collecting stuff, assembling it, pushing it across. It can be for your internal audit, your external audit, the regulator. For example, if you're in Lloyd's, you've got Lloyd's minimum standards every year that you've got. But what do? You fill in a spreadsheet and you send it back so that your supervisor of you as a managing agent can then compare it. Whereas, as you said, if it can be a node, the regulator can step in, whoever that is, the auditor, they can take what they need throughout the process rather than consume what we choose to turn over to them. And it's hugely inefficient.
Yeah, and you can read Victor Borman from R3's point regarding, that from the conversation he's had with Western regulators, it's around, resilience and ensuring this technology cannot negatively impact the consumers. I want to come back to the aspect about how this pandemic is affecting our day-to-day work as insurers. Now, here it says LinkedIn user. It's actually, her name is Kim Woolley. And she's saying, in insurance is such a historic market, which is often built on relationships, many of which is who you know or face-to-face interactions. How are you all finding the market changing, and how are you building new relationships without the ability to go for a coffee? Is a simple Zoom call sufficient, or a Teams call? What has been your impression as insurers?
For me, there are two things going on. There is a certain amount. I hate to say this, but there was a certain amount of over interaction in certain markets. I mean, some of the interactions that I witnessed while I was working for a Lloyd's syndicate many years ago, but the practices really didn't change, was you would physically bring a document around, get a signature, and this type of thing, right? This is not a meaningful interaction. So, on the one hand, there are some things, some clever systems. RiskBook is one of them that's developing, where you can have a subscription platform, which you no longer need to see the people to do what are essentially administrative tasks, which you don't need to meet people for. But then, of course, there is this growing comfort that we all have with Zoom and with virtual interactions, which is sort of fun, I'm finding. And I've understood that piece hasn't really been a huge problem for insurance companies. All of them are pulling through. Obviously, there's the claims impact, but all of them are pulling through, and it's creating different dynamics. And everyone mentioned this is a very generic statement, but some people are even finding that it enhances those relationships, because you see into the person's house, you see that they've got a cat, it's walking all over their keyboard, and sort of fun. But I think it's okay.
I think as well, for me, and I agree with all of that. I think relationships are kind of underpinned typically by two things: warmth. So can I find the person likable? Can I warm to them? And competence. And again, we're in a regulated space. We should be competent. That should be an order qualifier. But we also confuse some of the things that we did habitually. So yeah, you go to, people talk about the amazing inner workings of EC3 in Lloyd's of London, around there, the square mile, and the need for relationships. But again, it's an and. You can build a meaningful relationship, and we're seeing this blurring of the digital space and the physical space. And at the moment, we've got constraints. So we've seen this fragility, but we've also seen this adaptability of people to say, okay, I'm going to operate in a new way of working. Some of the axioms that I once held so true, like we can only do business face to face because of trust. And to be blunt, that was a myth. And I'm not going to pick on you, Laurie, but we talk about this is the trust business. Yet what we do is we put in place, because insurers and other entities, if they totally trust each other, why do we need an army of lawyers, in effect, as part of a proactive defense? And then why do we have a series of processes, even within organizations and silos, because we don't trust what's been passed from one department to another, let alone when we pass it outside of our organization? Yeah. So this lack of trust, and I don't mean trust as doing bad to us, but a trust in the process, trust in the information, has spawned a whole industry of inefficiency. And who pays for that? The customer. Soapbox over.
Yes. Now, gentlemen, we're rapidly running out of time, so I'd love for you each to give a concluding statement, on, has this pandemic made you more optimistic perhaps of the future, or more pessimistic with a view of, can insurance adapt? Can insurance embrace new technology? Can insurance really rise up to this challenge? What are your views?
Who wants to start?
Silence. Go ahead, Rory.
You're muted, Rory.
Do apologize. Okay, that's one of the learnings. Of course it has to survive. It's got a tremendous social purpose, which remains true to this day. So for me, if you look at the industry now, it is digitalized in the sense that everyone has a computer and uses some programs, but it's got a data management challenge, and its processes are very manual and old-fashioned. And I like the point Patrick made around benchmark rising and the ratings agencies starting to police that a little bit, or not police it, but comment on it, create the benchmark, and to compare market players. So that for me would be a driver. I expect it to, it may or may not be related to the pandemic, but I think it was sort of happening anyway. And everyone, whenever you mention technology, innovation, all this type of stuff, people immediately think of their sphere of operation. And as Mark said, I'm a lawyer. So I immediately think also of other things that are happening, ambient things, such as the new legal risk management standard that's coming out, which is a global one, ISO 31022. And that one will specifically raise the bar on topics relating to the law, and it's coming out this year or next year. So I think the expectation, the basic expectation, always sort of is going up, and you're going to reach some tipping points in various different of these technologies. And let's hope that blockchain is one.
Great,
I knew that Patrick was coming on. I was thinking about the phrase of, out of great adversity comes great innovation. So I was looking at the volume of US patents filed after the Great Depression in the United States, because I think sometimes we can learn from patterns from the past. So some of the trends, so the independent patent filings went down, so people on their own, but corporate patents continued. In fact, they were less impacted than the independents. One of the reasons was the really bright people out of independents started working for the corporates. But the other thing that we knew was the high quality solutions continued, and they thrived regardless. And I think, again, I come back to the point before that I don't think there's an option other than being on digital and doing that. And actually, I was speaking to a third-party administrator this morning, and he said, I can't believe the level of technology innovation we've pushed through in our company in the last 3 months. We did more in 3 weeks than would have normally taken 6 to 9 months, because it was a necessity. So we had to do that. And I think that will give us some confidence. Do you know what? When we can go a bit faster, and when we realize we've got to survive, think what we could do if we want to move into sort of really thriving and doing that. So I think I'm really optimistic. I think there'll be a lot more DLT activity, a lot more embedding. I don't think it's going to be as high profile because it will start to become our new norm, but it's going to still be massively impactful.
Yeah, I'd agree. I think, I completely agree with what you said too. On the surface, I think some would say that the efforts over the last few months, moving from home, like you said, the relatively manual industry that relies on this face-to-face interaction that we've been talking about just adjusted pretty much overnight to a work from home policy. That's crazy. But it happened. And I think some may say that, this won't have lasting impacts, but I think that's probably overly simplistic. I think that what's happened now may wind up being a key catalyst for tech adoption. If you look at this whole situation prior to this pandemic, tech adoption within the industry, the stage for that was really already set. The economic downturn will likely lower the amount of overall startups within the industry. However, the adoption rates for technology in the industry, I believe, will increase. And the count of projects related to the various technologies was already quite high. And we talked a little bit today about, the incentives from credit rating agencies and what have you to get further and to take those steps. It's all been set. It was literally set right around when this pandemic broke. And we talked a lot about what the other potential technologies could do for the industry, not just blockchain, but blockchain's interaction with IoT or AI. Because of all the above, I'm very optimistic, and I am because of technology. One thing I've learned from economics and about economic growth is, most folks think about capital and labor. They think about human resources, capital resources. But the one variable that's often discounted when you think about economic growth is technology. If you look back at the Industrial Revolution, you think about, you had capital, you had labor, but did we really think about what technology would do?
Yeah.
And because of that, I'm really optimistic about what we can do within the industry as folks looking at new technologies. I mean, this is a really exciting time for the industry. I'm optimistic that we have really smart people like the folks on the line here today that can start thinking about new ways to solve problems within the industry. So I'm optimistic.
Excellent. Well, gentlemen, we've got just under 2 minutes. For you listeners, put a little message there saying, tell us what you'd like to see in our next webinar, and please provide us some feedback about what you liked or didn't like about this first Blockchain Bistro. We have a ton of other questions, which I'd love for us to cover, but perhaps we're going to take two little quick ones. So we had here Mukdar Relan, who says, insurance has always been a push product, and now suddenly it has triggered this panic buying button. How will it sustain it in long term from a push to panic to pull product? Any take on that? And I would add, can this new emerging technologies help us achieve that? What are your views on this?
So I would say, again, if we look outside the industry, we're seeing so much as a service. So two things that for me are really, I think, are going to be influential. We've seen open banking, and we're going to see open everything. So the ability to see things and also the ability to switch without particular impediment. And I think the insurance industry, rather than it being an annual purchase and periodic payments, is going to be, and more than just usage based. If I don't feel I'm getting value, and for me it's that switch to service, then that's how we start to mature as an industry. We've seen it in health. So people like Vitality moved from being a pure product play to being a lifestyle enhancement play. That's helped them in terms of retention. Those would be the sort of things I think about, how we keep the pull there.
Great. Well, I'm afraid we're out of time. So thank you so much, all of you, to join us in this show. Patrick, it's always great to have you. It was good to have you on audio format, as a podcast, and now within a video in this webinar. Rory and Mark, Thanks. You guys are always awesome. So it's great to have you again, a part of our show. And to you, the audience, thank you for such awesome questions. You really made this webinar super interactive, and they were very thoughtful, very intelligent. So thank you again very much for all these questions. Feel free to send us a message, to add comments below in terms of what you like, what you didn't like about this show, what you'd like for us to cover in the next one. But for now, please stay safe, apply social distancing where possible, and we look forward to seeing you again. Thanks again, guys.
Thanks,
Bye-bye.
everyone. Bye now.